Good afternoon. This is Robert Rayburn here at Life Pro Asset Management. It is April 22nd of 2024, and I'm a little bit under the weather, so we're going to refrain from the video here and just record directly to the slides this week. As usual, if anyone has any questions, concerns, you can reach us at 888-543-3776. But of course, your best resource is to reach out to your primary advisor, but we are always here to help. So let's go ahead and get started. The big question we've been getting from investors is, the market has had 2 or 3 weeks now where it's been a slow, organized drawdown. In other words, kind of a term for sell-off as prices have gotten lower. Is it time to buy the dip? So we're going to go through and give our best attempt to answering that question. It's always a series of educated guesses in the short term. That's the reality of trading. But we wanted to go through three big things this week. One is, how do we navigate markets that are at all-time highs? There's a lot of what I would call false information or false coaching that is out there about the markets and how you deal with a market that's at an all-time high. Number two, how long will the market correction last? Again, the billion-dollar question: is it a 5%, 10%, 15% correction? In many cases, it's probably not something you want to try and time to the percent. So we'll go through that. And then lastly, what's working and not working during the correction? I think that's the most important thing. Market corrections really give us an opportunity to see what are those areas of emerging leadership. What are those areas that are perhaps getting replaced, where you're seeing leadership change? And what are the areas of the market that have gone from a weak position and are getting worse? So we'll go through all of that this week. First thing is, of course, why are markets pulling back? We used this slide last week. I want to use it again. Why? Because it's really, really important. Back at the beginning of the year, we talked about the craziness, the insanity of the market baking in 7 rate cuts. Why? Inflation was high, right? When I say high, I mean above the Fed's target. Fed has a target of 2% inflation. We're sitting around 4. Does not make sense to cut rates at 4 when your target's at 2. Why? Because then inflation is going to go to 5 or 6. Excuse me. So that ideology or that thought process really never made a whole lot of sense to us. So with inflation reaccelerating, the market now is basically at 1 or fewer rate cuts. Now this says 2.7. It's gone down more since this chart was put out there. So why does that matter for us? That matters because growth assets or highly expensive assets that need a lot of growth to justify their stock prices at current levels, you need low rates to justify that, or to at least keep the gasoline in the tank to get these stocks to move higher and higher. We believe right now that the economy is strong and that assets that are more cyclically driven, that have lower valuations, that you tend to see in the value area of the market, are more attractive. So we think we get this movement away from growth and into value-oriented stocks. And that's what's been driving our portfolio design. Now, before we get into how long this correction, at least how long we think this correction will last, I want to sort of address one of the other questions that we've been getting is, well, the market's near all-time highs. It was at an all-time high a couple of weeks ago. Does that mean it's time to take profits? And I want to be really careful with this idea that you take profits every time the market hits an all-time high, because quite frankly, you make most of your money when the market is at an all-time high, right? Because that's the idea of a bull market. A bull market is only born, in other words, the first inning of a bull market starts when you cross into all-time highs, right? So that's the idea of a secular bull market, is that you've crossed the high from the previous bull market high. That's a bear market ends once a new high has been established. So if we look throughout history, the average annualized forward performance for the S&P 500 after hitting an all-time high after 1 year is 9.43 versus on any other day 9.13%, right? So in other words, if you invest in the market after it's hit an all-time high, your forward performance historically, again, past performance is not guaranteed of future results, but your forward performance historically has actually been higher than investing in any other time in the market. And if we look at historically the number of all-time highs made by the year, look at where we get these clusters, the early to mid 90s. Imagine sitting out the 90s because you said, oh, hey, in 1992, we made 22 days where we hit an all-time high, or 1993 or 1994, 1995 or 1996. 1996 or 1995, 77 all-time highs. The message here is embrace strength. There is a time to play defense. There is a time to raise cash. And the market will give you time and signals to adjust for that. But not that signal is not because the market hits an all-time high. It's how it hits an all-time high. It's, do you have relative strength that's building or weakening? Is breadth narrowing or expanding? There are different ways to look at all-time highs, but all-time highs that are embraced by rising relative strength and rising breadth is something that should really be embraced. Now let's get to the correction, because that's really the topic du jour over the last few weeks. We are entering into this correction off a period of strength and rising breadth. That's really, really, really important. Were bull market trends healthy or weak when entering the correction? And the fact is that they were healthy. So we have this foundation that we can start our baseline decision-making process with, okay? So we entered into this in a healthy process. Now, what do we want to look at in terms of pulling the trigger on buys in a market correction? The percent of stocks making 20-day lows, right? So are the percentage of stocks making 20-day lows 20%, 30%, or are we in that 50, 60, 70% range? That makes a difference. The higher that is, the more likely that we're entering some sort of buyable low. Number two, the percentage of stocks that are below their 50-day moving average, right? So when you have the percentage of stocks making 20-day lows, 50, 60, 70%, and the percentage of stocks below their 50-day moving average, saying, again, above that 50, 60, 70% mark, again, the balance of evidence would suggest more confidence at buying that low. Volatility curve inversion. Are we buying portfolio protection at a higher price that is expiring in 1 month versus 3 months? If that inversion is occurring in line with these first two marks, then again, that increases our confidence that we're at a buyable low. And we'll go through what all of that means here in a bit. And then lastly, are credit markets healthy? If credit markets are not backing the sell-off in stocks, again, that's a really good green flag that we can go in there and start chipping away at some of our favorite stocks. So percentage of stocks at 20-day lows is beginning to spike. What we saw here is it reached about that 60% mark, backed off a little bit. Definitely expect that to repop here after Friday's sell-off. We look at forward S&P 500 returns when 20-day lows are above 50%. Again, you can see it's fairly attractive, again, within the auspices of a bull market. So we can generally check this off. The percentage of stocks at 20-day lows has definitely spiked. So that's good. We've worked off that short-term froth. Medium term, we still have some more work to do, quite frankly. So percentage of stocks that are above the 50-day moving average have sank to 30%. We'd want to see that below 20% so below 20%, while the percentage of stocks at the 20-day low has spiked, right? So this combined with this closer to 15, 20%, that gives us increased confidence. Where we're closer to that point is in the Russell 2000, where that's around 20% right now. So again, we're part of the way there, not quite. If you look at the percentage of stocks above the 50-day moving average, we want to see that lower in that 30%, or sorry, that 15 to 20% level. So the message here is we can be patient. This is still not quite there, what we've seen in the past. Volatility, on the other hand, we are starting to see the VIX curve invert. So what does this mean? Historically, we do pay more for insurance that lasts longer, right? So if I buy portfolio insurance that only lasts for a month, I'm not going to pay a lot for it versus if I get portfolio insurance that lasts for a year or 2 years, right? You pay more for more time coverage. But when that short-term coverage actually costs more than your long-term coverage, that tends to mean that there is some level of panic that has built into the market. Hey, I need insurance. I need it today. And I just want it for the next month because I think the world's going to end in the next month. Now, I'm being a little dramatic there, but like that's the mindset of when you get this VIX curve inversion, where you start to see that portfolio insurance that expires in 1 month costs more than portfolio insurance that expires in 3 months or 6 months or 9 months. And so when that happens, this line moves up, and that tends to at least allow us to try and time a short-term market low. Where we haven't seen the panic is in the put-call ratio. That put-call ratio remains somewhat subdued. I'd want to see this spike a little bit in line with the VIX, in line with the percentage of stocks that are making 20-day lows, in line with the percentage of stocks that are above the 50-day moving average. In other words, I want to see that hit a low. When all four of those things kind of coincide, that's where you get the greatest confidence that you can go in there and buy the dip. So summary is that a few check marks have been made, but there's some more work to do. Percentage of stocks, or sorry, the 20-day lows spiking, but put call ratios are still not panicky. So again, bottom line, patience. Percentage of stocks above the 50-day moving average is lower. Again, not quite to that big oversold level that we'd be looking for, but VIX is showing some signs of capitulation. So the odds are getting better. Is it a slam dunk? No. So we just want to be patient. What we do look for during corrections is, hey, what's working, what's not working? And quite frankly, the areas that pop up are areas that we have been talking about for a long time. The sector net relative high versus low list over the last 10 days, energy, materials, industrials. What hasn't been working? Tech, real estate, healthcare, right? So again, a lot of those dominant themes that we talked about going into this correction are holding up in the correction, right? So cyclicals continue to outperform, values outperforming growth, commodities are outperforming. This is something that is indicative of not a recession, but a strong economy that, where assets that have low valuations, but accelerating growth because of a strong economy and need a strong economy, perhaps can outperform some of those secular growth plays that are very expensive. And what we like about energy in particular is that the crowd hasn't really noticed, right? So we look at the equal weight energy index relative to the S&P 500 that continues to turn up, but the net flows remain negative. In other words, investors continue to sell versus buy despite some of the emerging strength that we've seen. Now, if this was way up here, that would be a red flag. But again, flows remain negative. In other words, we believe we're in energy before the crowd has started to come toward our area of the market. And so very indicative of sort of that phrase, we want to skate to where the puck is going to go. We want the crowd at some point to come where we are, but we're not there yet. That's good. That means we're in the earlier innings of that move. Again, is the stock market telling us something about the economy? Not in our opinion. Copper continues to break out. This is the actual chart of copper, despite the correction we've seen in stocks. Very unusual, the copper to move up in a risk-off tape. It's saying something is happening. And of course, that also tells us that, maybe something's happening in China. I know there's not a lot of negative press out there with China and Chinese stocks in their real estate market, but China buys over half of copper reserves, right? So over half of copper demand comes from China. China is the 800-pound gorilla in the copper room. Very hard for copper to move up if China is weak and weakening. So again, this to us is a bit of a leading indicator in what might be happening in China, Chinese stocks, and their economy. What's not working? Tech continues to break down. And I get it. It's really popular to be in tech right now. It's really popular to be in AI. It's really popular to be in social media. We're just not seeing the price action that would indicate value creation, at least over the short to medium term. And I know that NVIDIA was down 10% on Friday. So again, something to be cognizant of. A lot of these companies are great companies, but the crowd is, they're very crowded. So we just want to be really careful there. Corporate credit risk, again, very subdued. We're not seeing any red flags from the corporate credit markets. That's a big thing that we want to look at during corrections. Is it being led by the credit markets or the credit markets saying, hey, you know what, the world's actually not that bad? And right now, we're not seeing any warning flags. So in summary, good signals, scary noise. We want to embrace market at all-time highs. That's not a red flag. We don't just sell the market because it's at an all-time high. Now, if we're hitting an all-time high and the percentage of stocks that are participating in that rally is narrowing, that's a yellow to red flag. We want to pay attention to that. But that's not what we saw at the previous high. We saw good breadth, good relative strength from the right sectors. Number two, market correction is making progress, but we still want to be patient. Where we are seeing strength is in copper and energy and China and emerging markets. Those are the areas that we see building strength. So let's pay attention to the big picture. That's what I got for you this week. 888-543-3776 if you have any questions. And thank you again and have a fantastic week.